And that's, I think, what we really should teach people. I'm not out there preaching to people that multifamily is the best vehicle. I want to show people by our actions that if you do one rental at a time, one deal at a time, it will set you free.
One of the things I love to do at One Rental at a Time is bring on new faces and new voices with new experience. And we've got the double trouble of Jake and Gino here. We're going to talk about the multifamily space. We're going to talk about syndication. We're going to talk about the stupidity of the last 2 years. We're going to talk about the market cycle changing today. And ultimately, hopefully, spend most of our time talking about how the greatest wealth opportunity of my adult life is coming. But guys, we got to start with the stupidity. But before we do, let's introduce each other. Gino, why don't you introduce Jake, and I'll have Jake introduce Gino. Let's see how this goes. Gino, you're up first. Tell us about Jake?
It was 2009. I am in the kitchen sweating my ass off.
Woo!
And in walks this young buck with a three-piece suit on. I think it's the last time I saw him in a suit, by the way. He walks into
bling
the kitchen.
bling. He thought it was a mafia.
And I'm sitting there making Jake's chicken. I'm like, I finally meet Jake Stenziano, the zucchini, the peppers, the mushrooms, and I'm sweating. I'm going, bro, what's going on? How you doing? Jake was a pharmaceutical rep. He was using my restaurant to take out catering orders to doctors' offices. And I instantly found a little bit of admiration in Jake because I saw a young guy who was willing to work really hard, who's really dedicated to what his craft was at the time, was really, catering to doctors, telling Gino that I need an order at 10 o'clock in the morning to go to the Bronx. Very dedicated. He probably has his card stock right there. He'll show it to you right now in 3 seconds. And see, he'll pull it out for you. And I love that about him. Yeah, I know. You'll pull it out for him. And what I liked about it was we instantly clicked. He moved to Knoxville in 2011, and I said, let's continue to look for multifamily because 2009, New York, it wasn't working, and took us 18 months to find the first deal. And what I like about Jake as a business partner, as a friend, is the long-term mindset, the dedication, not making any excuses, working harder for me than he's working for himself. And I think that's what we should all look for in a partner. It's called values-based decision-making. And I think that has really propelled us. Did I have really great partnerships before, Jake? Absolutely not. So if you're on here saying, I need to do everything myself, just revisit that. Maybe it was you. Maybe you weren't the person who created value and brought value to the partnership. And I think both of us bring different kinds of value to the partnership, and we're both dedicated to each other.
I love that. That was very nicely done. Very PC. Let's see if Jake continues that, or is he just unleash?
No, I will keep it down the fairway and be very soft. Don't worry.
Nice.
And I will say this: when I met Gino, he was a tough guy. Yeah, he was just like that. And here's the thing: if you're not watching this on YouTube and you're in your car, you're missing out. Okay, because you're gonna see some things here in a second. Gino was a tough guy. He was in the back of the restaurant. He always was frowning. He was keeping things together. If a cook was out, if a dishwasher was out, he was jumping in. He was yelling at people. He was throwing shit at the wall. Like, this was a New York tough guy, okay? Looked up to him. I was like, damn, this guy's got some balls. He's got some discipline. Now he moves to Florida and he turned into a metrosexual. Look at him right now. He's got this Peter Millar shit going. I don't know. It's like florals and pinks and greens. Gino, I'm just kidding. I love you, man. I'm serious though. Like, when I met Gino, it was such a blessing. I was friends with his brother, like he said, working at the restaurant. And I was one strike away from getting fired from my job at the pharmaceutical company. I was not a fit. Healthcare reform was taking place. I just was not the person that they needed at the time. When I was hired on, it was a very sales-based, let's go out and make it happen type atmosphere. I learned a ton. It was a great culture. 2008 rolls around, healthcare reform, it switched on a dime, and all of a sudden I was this, odd duck that just was no longer needed there. They wanted people to read off the script, and it wasn't me. I was a make it happen entrepreneurial type mindset. Right. Met Gino, I was like, hey, I'm out of here. I'm leaving New York. Does not fit my values. I don't belong here. I want better weather. I want lower taxes. I want more freedom. I'm going to Tennessee. He's like, what? I'm like, yeah, dude, I'm out of here. This is after knowing him for a little bit. And, I was being mentored by a doctor at the time who was the only doctor left in our whole area that still owned his own practice. They all got gobbled up. They went from entrepreneurs to employees. They got plugged into the system. And there was one doctor that remained, and it's because he owned real estate. I admired the hell out of that. And then all of a sudden I got Gino in my ear talking about apartments. And so the world's kind of like coming together for me, and I'm listening, and I'm grateful for it. I'm so blessed to have met Gino Barbaro. He's been a mentor. He's been a more than just a multifamily mentor to me. He's been a personal friend, and he's the reason that I homeschool my kids and screw all the apartments. That was the best thing that has come out of the relationship with Gino, is that it changed my family dynamic. I think it set my kids up for success in the future. And Gino, here on live TV, we might not be live, but it feels like it's me. Thank you for that, my friend, and all the other guidance you've given me. G Daddy is the real deal. Even though he turned into a metrosexual Peter Millar, Florida pastel, he is still the man. And I know there's a tough guy under that pretty shirt.
And Michael, I have to add something to that. I know when Jake met me, he must have thought I was the weirdest dude on the planet. I'm eating organic food. My wife is homeschooling the kids, and she must have thought I was a little strange.
He got red pilled early, I guess.
So I didn't really push anything onto him. I just let him see. I let him observe. And that's, I think, what we really should teach people. I'm not out there preaching to people that multifamily is the best vehicle. I want to show people by our actions that if you do one rental at a time, one deal at a time, it will set you free.
Yeah, couldn't agree more. Let's start this clock in 2012 with that first deal that you found in Nashville, I believe. If not there, tell us where.
No,
again,
no. We got to go back to your original question here. I'm not trying to hijack this, but you're like,
no, let's go.
You know, multifamily went to shit this year. I got to talk to that because
no, we're getting there.
Okay, do you want me back off it, or do you want me to jump into it? Because I'm ready.
We're gonna hammer it. I just thought we would start with 2012.
Gino's the storyteller. I'll let him go on this one.
There you go. So let's just talk about that, because again, I do think 2012 was a great time to get started. Olivia and I had already bought a bunch of houses. That was kind of over because Wall Street showed up. But what we saw in 2012 is multifamily was being distressed, much like I think today will be. So we'll get to that in a minute. But 2012, lots of value add. Price points were very low. It was a decent time to be a landlord. So why don't you talk about that first deal, and then we'll get into the lunacy of the last couple of years.
Michael, it's 2011 when Jake moved down there. And I remember one day being in my basement, and Jake calls me up and goes, bro, I got to hold off this multifamily thing. And I'm like, I have 4 kids. I can't hold anything off. I need to make some more money here.
This was after a year of trying to find something too.
Yeah. He's like, I went and bought a house. I'm like, you went and bought a house? You're killing me. So I had to pause for about a month.
It was my wife's fault.
We got right back on the horse. It did take us 18 months. And the reason why it took us that long is we did not have a process or a map. I have life before Jake. I had a lot of turbulence, a lot of bad deals, and life after Jake. It's called buy right, manage right, and finance right. And it took us 18 months, as you can see by Jake's personality. He was a little rough around the edges when he got into brokers' offices. And Stenziano and Barbaro.
I might have got kicked out a couple times.
And he's kind of see, y'all ain't doing business down here. It took us a little bit longer. And, you know, we obviously teach our students how to build rapport, how to go on property tours, how to speak the lingo. But that first deal, believe it or not, and I love how you mirrored what's going on now with what was going on back in 2013, because debt was difficult back then. Raising capital was difficult. There were deals on LoopNet. Guess what? All 3 of those are happening right now. And people are exiting the building right now as they were back then. Jake and I on that first deal was a $600,000 deal, 25 units, weekly renters. When you say there's hair on a deal, this thing was Chewbacca, this deal. That's how bad this deal was. But that's where the value was. And we didn't know what we were doing. That's the great part about it. We thought, hey, we're going to buy this deal, go to monthly renters. And it took a little bit longer. But what I loved about the deal is it got us in. It was 25 little single units in on one property. It was as much as we could afford.
Cottages. Yeah. Some studios. Yeah.
I think the last thing I'll say about it is it was seller finance. We had a 10% seller carryback, 80% bank, and 10% we had to come up with, which is a total of $83,000 from me, Jake, and my brother Mark. So for those of you out there say, hey, I can't afford to get into multifamily, I don't know where the money's coming from, I've got 2 words: creative financing and syndication. Creative financing is working now. Syndication will work in the next market cycle.
No, I couldn't agree more. It's funny you bring this deal up because I just closed on a call with Stephen Dow from Velocity Mortgage, where today's topic was a 90% CLTV, which is what you guys did. You did an 80% first.
Yep.
You got seller carryback of 10%, which means you bought 25 units with 10% down. And I'm letting my audience know, as the market slows down, as people run away, the creativity is going to skyrocket. It's not all about cash like it was in 22 and 23. It's about understanding the seller motivation. It's about understanding your numbers. And I think there's a lot of people that'll buy apartment buildings with 90% CLTV, combined loan to value. So
Hey, you
it's
want to
funny
hear
that was your
something even
first
more?
deal.
You want to hear something even more interesting? I
Of
think it
course.
was our 5th deal. We bought 281 units with 0 down. And
Tell me that story.
I'm not
Yep.
advocating like this is like an everyday occurrence. We were in the business. We had 200 units already. So, you know, we're showing that we have credibility and we can operate these things. Okay.
Mhm.
Same type of deal. Sat around on LoopNet. They wanted a little too much for it. We said, hey, if you can give us the down payment, we can get the bank to finance it, because we had good rapport at that point. So instead of 10% down, they brought 20% down. You know, first month, all of a sudden rents were up 40 grand because the family was stealing from the owner, because they were the managers and they were also driving BMWs. And so, no, I'm serious.
Shocking.
Yeah.
None surprised me in
sad.
this game.
So look, I'm month 1, rent shot up, you know, tremendously. It's been still probably to this day the best deal we've ever done. It's refied out to agency now, and it just cash flows like a monster. So, you know, those type of things can happen, but you got to be in the business for it. Your first deal is not going to be 281 units owner financed. We may also never find that again, but we've done multiple owner finance deals since then, just not that large.
No,
So.
I think that's the key of what's, again, we'll get to we're going to spend most of the time on what's coming. I'll give you one of my last stories. I think this deal was done in 2012. I had a bank president call me directly. And I thought one of my friends was, you know, punking me. I thought it was a prank. It's like, which one of my friends is trying to play a joke on me?
That's something Jake would do.
Yeah, I'm sure he would. Don't give him my number. But what happened is the bank president saw that we bought the apartment building next door. His building was in trouble as well. He found out what we paid for it. He called us up and says, "You want my building for the same price?"
Was it the banks or was it his personally?
No, it was so at the point the bank took it back. It was the bank's property.
Just making
it was
sure.
their problem. Yeah, it was the bank's property. And he called me back. We met at the property on the weekend. It was like August in Fresno, California. He's wearing a 3-piece suit because he's the bank president. It's crazy. He had to be sweating through that suit. And he basically said, "We'll finance the building at the same price. We'll give you a discounted rate, nothing down. The only thing we ask is you put $50,000 in our bank and you use that as the first 50K for for make ready."
Oh.
I'm like, "Are you kidding me? Where do I sign? Like, write that up on Monday."
They love those deposits.
Yeah, exactly. They, fractional lending and all of that. So again, that's where we're going. Property is going to age out. Sellers are going to banks are going to be in trouble. So now let's fast forward from the good era of, call it 2011 to 2016, 18, somewhere in there. Then out of nowhere, Grant Cardone and others burst onto the scene with ideas like bigger is better. Everybody wants to become a syndicator. I went to an event in 2018 where I was the one rental at a time guy talking houses. They did not want to talk to me. They wanted to talk to brand new syndicators who live in the Silicon Valley, who are engineers, programmers, who were trying to buy properties in Ohio and Oklahoma, who had never bought anything, who had never managed anything. But boy, they had a lot of friends with a lot of money with stocks, and they were overpaying for properties in these eras because of bigger is better. That was the beginning. A lot of those people got lucky because they cashed out in 2021. But then we got stupid. We repeated the nonsense of single family homes with short-term bridge debt, adjustable rate mortgages, stupid assumptions. You know how many syndications I saw that assumed rent would go up 5% a month or 5% a year for the whole time they held it? We saw just atrocious deals. And I was warning my audience years ago about, you want to see a building go from 100 million to 50 million? Let me increase the cap rate. Let me lower the NOI. Bingo, bango. And here we are. So let's talk about just the stupidity of the last 3 years.
You know, Gracie to me, he said, "Yes, I can go." So one thing that that's really cool that we did, and it would have made a big difference, but I felt so smart about it, and that doesn't happen very often. So that first deal that we were talking about just a minute ago, it was 2018, and we put 10-year debt on it through a community bank at like 3.8% or something ridiculous. Nobody's doing that. They're all like, "I'll do 5 years." And so we have maybe, I think, 2 or 3 deals that are sub $1 million that aren't with agency, right? We have some newer stuff that we're doing loan to cost with, but anything that's, we call it send it out to pastures with agency, 10 to 15-year debt or whatever. I like to sleep at night, and I always want to take the rate risk off the table. So I've never done a floating rate deal. I never want to do a floating rate deal. We've never told any of our students to do floating rate. We have finance right components to our framework, and nothing that we've ever discussed there was a floating rate deal. We've never done bridge debt. Okay. So I felt really good because, I had, friends and people in the industry when we had some stuff at like 4.8%, that was locked into 10. What are you doing, man? Rates are 3. I said, buddy, I sleep at night. I got non-recourse fixed rate debt. It's cash flowing very well. And we actually do a lot of yield maintenance. Okay. We put on yield maintenance, keep us out there for the 10 years. We don't mess with it. We let it sit. We send it out to pasture. So that made me feel really good. We thought about that a few weeks ago. So I just wanted to bring that up. But it's interesting that you brought up Grant Cardone, because he's doing exactly what he should be doing. At the root, the guy is a marketer. You could say at the root, he's a real estate investor or whatever, but his highest and best use, I believe, is his marketing ability. So he's out there being bold, he's being brash, and it's bringing more attention in, and that's just what he does, right? And he takes that money and he repurposes it into deals. He raises money. That's how he gets eyeballs, etc. I think when he started out, before he started syndicating, I don't know for sure. I think the guy had maybe 2,000 units that he actually owned. So he learned the business to a certain degree. Then his marketing, his branding got built up. But the problem with 2018 to 2022 is everybody thought they were Grant Cardone, and they could be Grant Cardone, and everyone's not Grant Cardone because he has a unique ability to market and get eyeballs, and he had a track record in the business prior. That's where people screwed up, because they didn't have a framework. They got into the business not understanding the importance of long-term fixed rate debt, okay? And they blew themselves up. So I love this part of the market cycle. We have 3 deals under contract right now. We did a shit ton of units last year, and we're rolling, and it feels like 2012 again. This is great to me because I know how to buy in these types of markets where the price makes sense. I can figure out the rest by following our framework. 2020, we might have done 100 units. 2021, we might have done 100 units. And just for the folks at home, that's a shit year for us. Like we're not aspiring. We're aspiring to do 300-400 units a year. So our numbers were way down. The story behind 2020 to 2022 specifically was a lack of discipline. People were playing chicken with the Fed. They can't raise rates. Okay. Then they did. Then they were screwed because they got big eyes. People were throwing money at them for deals. And you give a syndicator money, they're going to go spend it, regardless if the deal makes sense or not. And that's why Gino and myself are actually starting to also educate LPs, limited partners, on what a good deal looks like. Because so many people got the wool pulled over their eyes. They're just like, I'm going to give money because this person's got a podcast and I trust them. That's great. All of a sudden, taxes went through the roof. Insurance went through the roof. Rates went through the roof. LPs left holding the bag. Not a good story, but that's basically what happened. So if you would have remained disciplined, and that's where the issue came in, if you would have remained disciplined, not overpaid for deals, not stretched yourself using bridge debt, if an agency is not going to give you a loan and you're a syndicator, maybe it's not a good deal. Here's the thing, gang. You want to create a buying criteria, listen to the insurance companies, listen to the agencies. They're going to tell you what works by a shit ton of historical data. This is not that hard to figure out.
I think that's such wise advice. Go ahead, Gino.
Michael, the only couple of things I would add is I love your brand. It's one rental at a time. And that's what Jake and I really preach. We may own 1,700 units now, but we've been doing it since 2013. If you buy an average 100 units a year, which could be 1 or 2 deals, you'll arrive at your number. And I think the cheap money allowed it. People were buying stabilized deals, stabilized on bridge debt. Not a good idea. Now,
not a good idea.
I'm not throwing all bridge debt under the bridge, because sometimes it's really valuable. If you're an experienced operator, you have a business plan, you have a viable exit strategy, and you can execute. It may be a good plan because you can get it done within 2 years.
I still prefer loan to cost. I know people are going, oh, but there's a recourse component. Yeah, but you're not playing with fire as much. Like
I agree with you, but I'm saying if people want the alternative and don't want that recourse and they want non-recourse, if they know what they're doing,
and
it's a
more
good
expensive
tool.
Yeah.
Oh, dude.
It's
Holding my nose. Meh.
Not part of not this. I love the fact that you guys had shit years in 2020 and 2021. You're supposed to. If you're conservative, if you cash flow day one, if you use real financing, you should not be able to find deals when everybody has free money
Our
and
cash flow
everybody
and
is
operations were
overpaying.
great, so I don't want to, be
Of
like
course.
inconsistent. We just were not growing like we wanted to, and that was okay. And
You're
we
not
were
supposed to. Everybody's overpaying.
Yeah.
This is not a unit.
It was really freaking hard. Yeah.
That's what annoys me. This mantra that bigger is better. I'll agree, bigger is better sometimes. I might even give you bigger is better most of the time.
It's not to
But
be
bigger-
taken literally, though. I'm going to step.
No,
I'm going to step in for
agreed.
Grant here. That is all of it is look. It's the same shit with Donald Trump. Big, beautiful buildings, baby. Yeah, yeah. And like I have a terrible Trump impersonation, but it's marketing, guys. At the end of the day, and like if you get too caught up in that and you take this shit literally, you're gonna get in trouble, right? This is to get people engaged, to get people fired up, to get them, in the ecosphere, and then raise money from them. Like I'm not hating it, just saying what it is. Like,
no, I agree. So let's just put a pin in this because again, I think we're just starting to see the pain. There's a lot of LPs that got in. It was kind of like the game of musical chairs. Unfortunately, there's a lot less chairs, which means lots of LPs are going to lose. Lots of them, I think, are going to lose everything. Lots of them are going to get hit with depreciation recapture. How is that for a kick in the teeth? You lose all your money and then you have to go file depreciation recapture. That's going to suck. So a lot of LPs are going to get hurt. I think a lot of LPs will never touch this space again because of this, which means they're stepping out right when the opportunities could be life-changing.
It sucks.
Yeah, it's painful.
Yeah.
And Michael, that happened to me back in 2005. I always share the story about Maserati Mike. I invested with a gentleman who had a nice gold Maserati. I gave him 172 grand. 6 months later, he stopped paying. And about a year later, money's gone. And to me, I could have done the same thing. I could have stepped out. I lost a good 3 or 4 years. But if you're going to continue to invest in life, you need to invest and understand why that deal went bad. I was blaming Maserati Mike. And listen, he had some fault. If you're an LP and you have put money into a deal, you should have the right to be pissed off. But you need to look inward as well. Did you do your due diligence? Did you, vet the sponsor? We have a 3-step framework for that as well. We call it the jockey. We call it the alignment of interests, and we call it the horse. So the jockey is the sponsor. I mean, you as an LP, did you really vet that sponsor? Did you ask him, hey, how has NOI grown the last 3 years? Ask him questions like that. Did you vet his team? Did you vet his business plan? Did you go back the last 6, 7 years and see what their track record was?
Are you using fixed rate debt?
I mean, those are all the questions. The next one is
why are you underwriting for 20% year-over-year rent growth in perpetuity?
Yeah, dude, some of these deals I saw the last year were just horrible. They smelled so bad.
Are you accounting for taxes doubling?
Exactly. Yeah,
it's important. I think just 2 other things with this framework. You've got the sponsor, vet the sponsor, but then next, your alignment of interests. If you have $62,000 in the bank, that's your last 62 grand. Should you be putting 50 grand into a deal? I mean, there's risk in it. People weren't thinking about it. Understand what your interests are, what your goals are. Do they align with the sponsor? If the sponsor's deal makes more money, does he make more money? And do you make more money? What are the fees? Understand the business. And then the third part, let's look at the deal. Everyone as an LP was just saying, I want deals. I want deals.
I trust this person. Yeah,
yes.
I trust this person.
You need to
take
look at
my
the
money. Take my
first.
money.
Yes.
Yeah.
Look at the sponsor first, then look at your interests, and then let's talk about deals.
Yeah. Unfortunately, we are where we are. Can't unring the clock. There's lots of people that are going to lose. I think when we add up the dollars that individual investors lose, I firmly believe this will make the Great Recession look like a small potato because
you think so? You think it's that much, huh? Okay.
Mathematically, no question. Because again, what people may not realize is the banks took it on the teeth with the Great Recession because the debt was 97, 98%. So there was no equity.
Yes.
Even deals with bridge debt, there was 20% equity, 25% equity.
You're saying
that's all gone.
There's no like bridging the gap with bailouts here because they're not going to help out a mid-level or small level syndicator, right?
Yes.
No chance. No chance.
Yeah.
They'll help out the Grant Cardones, and I'm not saying Grant's in trouble. I'm just they'll have a list of the top 10 which they will bail out. They're like,
I
hey,
don't know
good.
if they're helping out a grant. Like they're helping out a like a Blackstone. Okay.
Sure.
Right?
Yeah. No, agreed. Agreed. Oh,
Yeah.
guys, I don't know if you saw this. I just reported it today on the Daily Financial News. Goldman Sachs walked from a San Francisco deal, 1,200 units.
700 million bucks, right? 700 million bucks.
700 million.
Yeah.
You know what's really crazy? Because they bought it over 4 years from 18 to 22. $700 million deal combined. Debt was 687. Why did Goldman Sachs walk? Because they only had 3% equity. Of course they're going to walk.
Yeah.
Yeah.
What are you guys thinking? I mean, just crazy.
That's
So
insane.
yeah, it's insane. Bank of Canada, congrats. You own 1,200 units in San Francisco because they're the lender. They're going to own 1,200 units. So let's talk about today, because that's really where I wanted to get for this. I do think there's a lot of similarities between where we are with like 2011, which was you were starting to see multifamily pain. I think 2025 will be like 2012, which is where Olivia and I added almost 100 units of apartments because banks finally gave up. Banks finally foreclosed. I think there's a lot of extend and pretend. There's a lot of, oh, we'll give you a year nonsense. But I've been here before. You know what happens when you give a borrower an extra year? They bleed the property dry because there's no equity. They know they're screwed. So that building, that asset quality just goes. So I think 2025 is going to be a lot of fun. What do you think?
We've seen it. We've walked buildings before where sewer lines and crawl spaces are pouring feces into the dirt, and it's absolutely disgusting. And the reason I like times like this, specifically, banks are stingy. So if you know you're out there, you don't have a track record or whatever, it's creating opportunities for guys like Gino and myself. We don't syndicate deals. We buy with our own capital. Nobody's giving money to syndicators right now, so we're not competing as much. So I'm sitting here saying, this is a party. Let's roll. That's why we got 3 deals under contract right now. Yep. It's exciting. It's a great time to be alive. It's a great time to be acquiring assets. So for me, I love moments like this because I do like to grow. You know, bigger is better. No, buying stuff that's great deals for the long term it really excites me. So that's the part of this market cycle that gets me so excited.
Yeah, if I had to guess, I would tell you guys, I think we're in the second inning of at least a 9-inning game. It may go extra innings. So if you guys are already excited,
things are not reported as much as they used to be. And I'm not trying to be like, you know, conspiracy guy or whatever, but like, I truly believe that like a lot of this financial stuff is either smoothed over through some kind of bailout or they print some money and it's just
commercial banks can't extend and pretend that. I've been here before. I know what I've talked to banks. I don't know if I know you guys go to your bank. So I went to a lender, which you have to do yearly when you own commercial debt. They look at your portfolio, the financial statement, all of that. So we do the shtick. We're fine. You know, bingo, bango. He points at his desk. There's a manila folder about this thick. And he goes, do you know what that is? No idea. What is it? He goes, those are all the loans that we can't, that we have to force to be refied or sold by someone else.
Wow.
Did you say, can I look at that?
Of course I did. Of course I did.
Did he let you?
But here's the point. A lot of those loans were performing, but they just got to get out. They're too indexed on a city or an area. So this commercial bank stuff, too concentrated. It's going to be bad. And we're early.
Who do you think? Who do you think gets creamed? Like the community, the regional banks here? It sounds like everyone's saying that there's the most risk in
regional banks for sure are going to get really, really hurt. Oddly enough, I think credit unions will be fine.
That's who we're using right now.
I think credit unions will be fine. They hold a lot of stuff on their balance sheet. They don't kind of sell it off. So I think they're going to be okay. But I think it's the regional banks that tried to act like the big boys that aren't too big to fail. There's some consolidation coming. It's a lot of pain.
What's the one that was lending a ton on multifamily? It was a Community Bank of New York or something like that. They just got whacked.
Yeah, they were doing not only multifamily in New York,
non-recourse multifamily,
non-recourse for affordable housing.
Yeah,
affordable
not just
housing.
in New York though, right?
Fixed expense or fixed rents. It was not good. They got whacked. But Gino, you were going to say something. I cut you off.
No, I just wanted to mention a couple of things about what's going on in this part of the market cycle and where we see the opportunities. The first thing is if you're looking at an older asset, 1970s and older, they're probably going to be trading around 8 caps. That's the reality because there's so much capex.
Gino, you
There's
smoking crack, man.
Bro, I'm telling you, in some markets there aren't, but you go into the Austins, you go into the Houstons, you go into some of these markets, you're going to see these older assets trading
I hope
between
so.
7 and 8
I hope
caps.
so. I haven't seen it yet.
I'm telling you, a lot of our
yeah.
students are coming back to me and telling me, hey, these deals, because once you start really looking
On
at the
pro forma or on
reality,
actuals.
based on actuals, I mean, like you
Holy
see,
shit! Somebody
yeah.
making some money.
Well, listen, I mean,
Well, somebody's going to take a haircut too. Let's not forget that part of the story.
yeah. And I think the other component is that we're buying from developers. So developers out there right now are having a problem. And what deals we're buying from is this developer's got 2 beautiful assets, 18 and 19 builds. He needs money for his next venture. So he's owned these things for a couple of years. He needs to cash out. And I think that's where that opportunity is right there. And for us, these smaller assets where, between the $3 and $5 million, where the mom and pop investors are like, you know what? I can't get the money for this. And you have the private equity. Yeah, exactly. I think that's where you're seeing a lot of opportunity in this part of the
Also, people are saying that, if this guy's not trying to be political here, but they're saying if Biden gets reelected, they're worried about capital gains going up. And so there's we deal with direct to seller guys, right? So they'll go and speak directly to the owners and things. And they're seeing, especially in the smaller and the mobile home park space, that a lot of folks are coming to them if that happens, they're trying to exit. Now, this was sort of a few weeks ago before there was like this momentum shift, if you will. So maybe that cools off a little bit, but
yeah. I just think this next cycle, I think it's going to be multiple years. I think folks really need to skill up, creative financing, 90% CLTVs, like we talked about your 12 deal in 12. There's a lot of opportunity. A lot of people in my world are talking about a housing crash, which I think is complete nonsense. 30-year fixed rate debt, almost everybody's below 4.
That? What's driving the housing crash?
The narrative is clicks and doom. Doom sells, man.
Mm-hmm.
There's a lot of crash throws.
But that's shit's been going on for 5 years now. It's like at some point they'll be right?
I don't know, dude. I deal with it every day, given my name, one rental at a time.
No. I'm saying, like, I feel like for the last 5 years, people have predicting like a housing crash.
I've been hearing it since 2012.
Whatever. So at some point you will be right. If you say the same thing for long enough, at some point it'll hit, right?
So Michael, why do you think there's not going to be a housing crash? What are your thoughts on it?
Well, again, I think most people have fixed rate debt, right? 2006, 51% of loans were ARMs. Today, 99% are fixed. Most people have below 4%. Unemployment's still 4.1. There's just not this buildup of pain like last time. And then the last thing to point at, which should be obvious to anybody who's paid attention, banks are fundamentally behaving differently in single family. What do I mean? Last time, I lived through it, banks told you the only way we'll work with you is if you're 90 days late. And then if you got 90 days late, statistically speaking, you lost the property 9 out of 10 times. They just sit you in OD and they went through foreclosure. Today, what did we get during the pandemic? Oh, forbearance. You want 3 months, 6 months, click this web link. So even if we have a spike in unemployment, forbearance will come out of nowhere. We're just not going to have this wave of distressed inventory. So single family is not coming. That said, the pain is in multifamily. I believe if you look at commercial real estate as a whole, we're already down 25 to 27% as a unit based on who you read.
What about office and retail in San Francisco?
Oh, dude, office is, I don't know, 50 or 60%. We just talked about it. I mean, there are locations that are really, really bad. But the point I want people to realize is anything over 5 units, I particularly play even smaller than you guys. I play 5 to 50. Like you, it is only my capital and my wife's capital. I have zero interest in syndicating. I don't want the phone calls. I don't want the responsibilities. I sleep great. I don't want to take investor capital. So we stay 5 to 50. That's all we play.
Also, we educate people. And I feel like there's this thing with all these educators out there that are like, hey, come educate with me. And then I'm going to raise money from you. And it just seemed disingenuous. Like I felt, I didn't want that. Right. So we don't compete with our community. Like I'm very proud of that. Right. So
Yeah, I love that. If I remember your guys' story, you did syndicate a couple of deals, but you didn't like it, so you got out. Do I remember that story correctly?
we
Yeah,
did. We
Michael.
syndicated like 3 deals. Go ahead, Gino.
Yeah, in 2018, we were sort of running out of money. We were in the between the refi of a deal, and we said, listen, we're going to start educating. Let's learn how to syndicate a deal. And we did 3 syndications, two in 2018, one in 2019. And after the third one in 2019, we said to ourselves, our biggest metric is PPUs, profit per unit. That's what we want to focus on. And when you syndicate deals, you tend to have less equity. I mean, you do have 30% of the GP, and you could put money on the LP side as well, but you don't have control. It's a great model to get in. It was a great model
And it
for us to
forces
get
you
a
to sell.
stopgap.
Like
Yeah,
it basically
yes,
and that's what I didn't
yes.
like about it. And to your point, it's another business in itself with investors. And I just was like, look, I like owning these things. I like seeing them that grow, mature, and hold them. And I don't want to,
Mhm.
raise money from people and then like okay, it's gone up in value. Let's sell now. And
Yeah.
it was a values misalignment. And so, we got real with ourselves and said, hey, this we learned it. It's great. We can teach people on it if they want to do it.
Yeah. like
But
it.
ultimately it just wasn't a great fit for us. So, but we did really well. It wasn't like a
Yeah,
performance
I'm
thing.
sure you had great
Yeah.
timing. I mean, you bought in 18, got out in 2021, whatever it was,
Yeah.
killed it, crushed it. Your investors love you. Probably wanted to throw more money at you.
They did. It was
I'm sure
actually
they did.
I was afraid. The first one, we needed to raise $2.5 million, and I'm like, "Do we do this?" And we just started the Jake and Gino platform. We had the podcast going on, and within 48 hours, we did that. I remember the second one was a little bit more challenging because, hey, we're telling people we want to hold your money for 7 to 10 years, and people at that time were like, "No, I want my money back in 2 years." So we had to change the pitch on that. And in the third one, same thing. The third one, we raised it within like 2 or 3 days. Self-directed IRAs were the rage. Everyone was putting money into them, and half the money. If you're going to syndicate, make sure you learn what self-directed IRAs are and get people to put that money into your deal. But to Jake's point, it just wasn't for us where we're going to you get this nice golden goose. She's going to start laying eggs, and then you're going to kill the goose, or you're going to trade it and go find another goose. It was just too much work for us
Plus,
to
we're
be able to do that.
operators. I think like from day one, we've been operating our own properties. And
Mhm.
so it was, I think it's great for people that like raising money, like Grant Cardone. He doesn't self-manage. He goes out, he raises money, puts third party in. If that's your, skill set, right? You're probably better off being a syndicator.
Mhm.
I've always enjoyed owning these things. It's like a legacy wealth play for my family. I love long-termism. And look, we put long-term fixed rate debt on our loans. We rarely sell. The only stuff we sold was the syndications. And also they were in Kentucky and we didn't like the laws that they came out with during COVID. So there was just a lot of misalignment there. And it was like, okay, it's time.
Yeah, we're out. Get them back. Well, do me a favor. You guys are doing lots of great things. You're really showing people how to move forward. I'm very much the little guy on this conversation, one rental at a time, a lot of single family homes. If somebody wanted to figure out what's going on with Jake and Gino and think bigger and do bigger things, where do we send them? What's going on in your guys' world?
JakeandGino.com. Listen, I just launched a book called Baby Money Soldiers. I'm going to send you an ebook on this. This is really my passion is really to teach people about financial intelligence, financial education, to get them to opt out of the system. Because I think ultimately people with financial intelligence can change the world for the better. And this, to me, it really struck back in COVID when I had the ability to say, hey, I can make choices. I don't have to do what my employer wants me to do. I've got enough money to sit around. That's what I want everybody listening to this, to have the option to have enough money in the bank to make decisions based on your values and not on somebody else's values. And if you buy one rental at a time for the next 5 or 6 years, you'll be able to have that optionality and the ability to do that.
Yeah. And I don't think there's a misalignment here either. We have 3 going right now, but typically we like to spread them out. And the way I've set the closing, we got 1 closing a month for the next 90 days. So it's, we like to onboard them, make sure that there's a great resident experience and focus on that. So look, bigger can be better, right? Just understand what's really behind it, I think is the key takeaway to that. But multifamilies, it's just been amazing. It's changed my life, forever. Obviously. And it really created a landing place because I wasn't a fit for corporate America. And now I can, be in the middle of the day talking to you guys, go work out if I want, come back to the business. It's a great amount of freedom, even though we work our asses off. So.
I love that. I love that. You guys are doing good work. I love what you guys are doing. JakeandGino.com. Give them a look. Follow them on Instagram. I love what they're doing there as well. Guys, any closing thoughts? And let's wrap this up. We'll go to Jake first. Closing thoughts.
This is what we always say in the podcast. We believe in buying deals for the long term, thinking decades. I'm Jake. He's the G Daddy, and you're one rental at a time. I'm closing stuff. We'll see you guys
Later. I like it. Gino, you want to say anything else? Thanks, guys.